Good morning. I'm Richard Calhoun with Creekside Realty. We're here to talk about the real estate market, have 40 years of working with buyers and sellers. Here is the overbidding. This is the magnitude of overbidding. The redder the color, the higher the buyers are overpaying. The bluer the color, the less under asking price they're bidding. And you can see that the colors aren't very intense in comparison to the upcoming slides. This is the frequency of overbidding. So basically what this is telling us is buyers are willing to overbid very frequently, but they're not willing to overbid very much above the asking price. So you can see the different colors. The more intense color, the higher the frequency. And at 75%, three-quarters of the sellers getting more than their asking price. It's the darkest red I have. At 42%, it's no color. And at 20%, it is the solid blue color. And this is the other key metric, in my opinion, days of unsold inventory, the same concept, except with days of unsold inventory, the lower the number, the faster the marketplace is. So here, the fastest areas are the reddest, and they go solid red at 24 and a half days. You'll see up here, a lot of these areas are way under 24. I mean, you got 17.2, and it's not just statistical fluctuation that Cupertino, Sunnyvale, and the Campbell, Cambrian, Santa Clara, Willow Glen area both came in at exactly 17.2 days. Milpitas is at 11.4 days, which is just unbelievably fast. But, and when the buyers are seeing everything snap up, they overbid all the time, and then they start overbidding more and more. So here's looking at the days of unsold inventory in each one of the micro market areas. Now, if you look at the right-hand side of the graph, notice all the lines are going up. And normally in graphing, up and to the right is a positive, but with days of unsold inventory, that's saying it's increasing, which is a negative. But what we have going on here is just a fluctuation of the holidays. It's nothing to be concerned about. If this was happening normally, this would be a significant change. As you can see, each one of the areas are going up for the most part. There's the yellow one down here that's basically flat, but the vast majority of these lines are all going uphill, which would be a slowing marketplace, but it's going to be short-lived. Here is days of unsold inventory. The blue line is the current year's data. The yellow line is the gold standard, which is 5 years, 2015 through 19. And at the end of last year, we were on the far side of the graph here in week 51 and 52. Now, since we're at the beginning part of the year, we're back over here on the very first data point. And it didn't work out as well as I was hoping because of the discontinuity. But if you take your blue line, you were sitting here at 40 and you're still at 40. Your gold line was up around 50. So the gold line would keep on coming up here. So the blue line is quite a bit underneath. The data for week 2 through 52 is all last year's data. What I'm hoping is once we get a couple weeks away from here, we can see the discontinuity from this year to last year. With one data point, it's really hard to say because, you're here versus here, which is not a big deal. But if you were up here at 50 and you're going all the way down to 30, that is a pretty significant drop. So I may have to redesign this. I'm hoping not, but so now we're at the left-hand side at the beginning of the year. Here is looking at the three major components, all compared to the gold standard, that 5-year median. So if we were having a completely normal year, all the lines would be right here at 100%. And you can see at the end of last year, the blue line was quite a bit above, which is your available inventory. Your gray line is the number of new listings in a given week, and it was up, but the number of new offers was significantly higher than both the number of new listings and then the available inventory. 180% of the offers you were expecting. So 80% more than the offers you were expecting. The new listings coming on the market were only 40% above what you were expecting, and inventory was only 40% above. So if your total reservoir is 40% above and you're only having 40% more water flowing in, but you have 80% more water going out, eventually you're going to run out of inventory. And that's basically what's happening and that's why the days of unsold inventory are so low. So now bringing it up to the current week, you have to come over here and you can see this week we were at 160% of the new offers. We were at 155% of available inventory. So those were almost in balance. And the number of new listings was at 110%. So the new listings is way down, but available listings and offers right now are sort of in line with each other, which is why the days of unsold inventory were going up. Because if you go back to last week last year. And even though it was the January 2nd, it was last year because I start my weeks on Saturday. So Saturday of last week was still in 2020. So that was why I'm referring to last week as a 2020 year. And that was week 52. Hopefully it'll get a little easier once we get away. This is a little easier to see. This is total inventory, so there's no big change. You'd expect inventory to be down here at 750, and we're here at 1250. So all of a sudden you start thinking to yourself, wow, that's sort of contradictory. We're having an extra 500 listings, but we're also having extra offers. So that's why you need to look at both sides of the equation. Again, the blue line is the current data, and I guess I need to change these years from 2020 to 2021, but the first data point is 2021. And you can see we have more inventory now than the 5-year median. And also remember the 5-year median selected 15 through 19 were 5 great years. So even if we're at the median, that's still a great year. This is the new listings for the given week. So you can see this year we had about 350 new listings coming on the marketplace versus an expected 300. So, somewhere around 15% more listings than you were expected. This is the number of new offers. So you're only expecting somewhere around 140 new offers, and you had somewhere around 210. So you had 50% more new offers accepted than you would have expected for this time of the year. This is looking at frequency of overbidding, and something that's starting to just puzzle me, and I don't have an explanation for it, is notice there's a little bit of sawtooth in a lot of this data. You can sort of see the general trend, but there's a sawtooth, and it's pretty pronounced at the end of the year. And going from week 1 to week 2, that is not a data point because this is last year data. So you can see last year we were down here at only about 43% frequency of overbidding. Now we're at something like 58%. But again, that just gives you an idea of how much. And again, this is macro data. So it's Santa Clara County, San Mateo County, single family and condo townhouses, all thrown in the blender to see what's going on. And this is each one of the micro market areas. So here we go over to the right-hand side of the graph. And that might be part of why I'm a little confused as you go from the left side to the right side. And I was hoping not to do a timeline like this, but just repeat weeks, but maybe I'll have to do a timeline. We'll see. And I appreciate feedback from people seeing it live and on YouTube. But here you're not really seeing any huge trend upwards or downward on the frequency. And if I was to pick any direction, I would say there appears to me to be more lines going slightly uphill, which means it's going to be more and more frequent that sellers are getting higher than their asking price. Now, here's the magnitude. And again, you can sort of see the sawtooth. And part of the reason this is so unexpected to me is if there was a holiday or an event in the marketplace, that impacts the offers. And I definitely see that in my data. But your close of escrows, they tend to meld things over because you have some quick escrows closing in 1 or 2 or 3 weeks. And then you have long escrows that are closing in 7, 6, 8 weeks down the road. So market fluctuations tend to get blended out. And then to see the sawtooth, so I've gone back and again checked my data, and I do not see anything wrong with my data. And over on the left-hand side, again, this is the data point. So now we're overbidding is a little bit above 103%. And last year, you were basically just at about 100.5%. And just even last week, which was last year, you were sitting here at 102%. So the sawtooth went, up, down, and then it went up to get over here to be at 103%. The horizontal purple line was when shelter in place was announced. And then this is looking at each one of the micro market areas. And this looks to me a little bit flatter. Some of the areas down here, which are nothing, seem to be more flat and going down. Some of the ones up here seem to be more going up. So we may be having a little bit of a split in the marketplace, which isn't that unusual because they're plotted here by frequency of overbidding. So if people aren't overbidding much magnitude wise, they may be going, hey, the market really isn't all that hot. We don't have to overbid so much. Let's slow down and let's not offer as much. This is my typical overbid distribution. And there is something towards the left-hand side that I really want to point out, and that's this bulge here. We haven't seen this before. You can look at all the lines on here. There's 24 of them to look at. You can see they're all very similar in shape. And now you have this discontinuity almost. And then if you start looking, you've gone from up here to sort of in the middle of the pack, And then down here on the lower side, it's sort of at the bottom of the pack and at the very bottom of the pack here. What do I think is going on? I think we have a split marketplace. I think we have the homes that have been on the market for a long time and for whatever reason are overpriced for their condition. And those buyers are willing to go in and offer more below asking price than they historically will. And that would be explaining sort of this bulge. And I think the bulge up here is starting to reflect what's really going on in the marketplace. A certain percentage of the buyers, and it would be somewhere around 23%, 22% of the buyers, are getting outbid multiple times, and they're getting frustrated, and they're finally saying, this market is strong. It is stronger than people are indicating. I'm going to bid higher overbid in order to get this next house. And so people that have been frustrated and haven't been successful are now coming and bidding up here. And I think that's why we have this very unusual shape. And it bothered me enough, but it's also just 1 week of data, because we're trying to look at the macro data. So we're looking at, everything in Santa Clara County, everything in San Mateo County, but it's only 1 week data. And I think it was about 279 transactions in the last week. So, that is not a lot of data, but I think the way I'm reading this is more than statistical fluctuation. If it was just this little bulge here, I would say maybe statistical fluctuation. But when you have it going down here at the lower end too, I think something more than that is more than statistical fluctuation is going on. Now we're looking at the same data, but just not for as many weeks. And you can see that we're towards the upper end up here. We're towards the lower half of the pack here, and down here we're one of the worst performing areas. So you see the same trend. It's just a fewer number of weeks that I went back. And again, these are all 1 week macro data. Now this is macro data looking for the month of December. And you might say, well, we're out of December. Yeah, I had a little debate with myself. Should I do January, even though we're on January the 9th? Because my December data, remember, goes all the way through January the 4th. And last night was January the 8th. So it was either I used 35 days plus 4 of the new ones, or I used just 4 days of the new one, and I decided to go with the old one. But I will most likely change this for next week. But the red line is the current data. You can see you're towards the upper end of the pack. You're not at the top end of the pack. This is, again, the macro data, Santa Clara and San Mateo County. Same concept, but just more recent. Again, you can see we're one of the better years at the top end, sort of in the middle of the pack down here, and even in the middle of the pack down here. So that says that Decembers have been pretty bad. And then you got to be a little careful when you start looking at this, because this happens to be 2010 and 11 down here, which were, the slow years coming out of the recession. So they were clearly not great years. But again, it's not doing particularly well at the bottom end, but it is doing very well at the top end. Now we're looking at single family in Santa Clara County only. So we're going away from macro data and just trying to pay attention to what's happening in the biggest area. And I would say this is outperforming the macro data. It's at the top up here, like all the others have been. It's near the top in the midsection, and it's actually near the top in the bottom section until you get to the very end. And then it's still in the top half for sure, if not the top third. So this tells me that single family homes in Santa Clara County are doing better, and that's half the marketplace than the entire marketplace overall. So what that's really telling us is single family homes in San Mateo County, condo and townhouses in both counties are most likely not doing as well. And when I look at other things that I don't have the charts on, what I see is out of condos and townhouses into single family homes, skipping over condos and townhouses right into the single family homes. So there is definitely a different marketplace. And here again is just the most recent 10 years. And now we're looking at the price range. So we're looking at single family homes only in each of the micro market areas. And what this is doing is that the coloring is the price for the given area, the median price for the given area compared to the median for all the other things. And what's actually somewhat interesting is you look and say, wow, here's a whole big area that's pretty white, plus a little tinge of red and a little tinge of blue, but they're all pretty close to the same color. What's going on? And you come over and you start looking at here and you look at the median price, 1.88 million, 1.93 million, 1.91 million. I mean, and even 2.02 million. It's surprisingly close together. And this is even true over last week. There was more color dispersion last week, color variation, where now there's a lot right there at the median price. So I just found that interesting to note. Again, the bluer the area, the cheaper priced areas, the hotter the area, the more, not the hotter, but the more expensive the area, the redder the color. And as I just finished saying, there's a lot of areas right around the median for the area. Here is the data for the last week. You can come back and look at whatever data point is most interesting for you. That was Santa Clara County. This is San Mateo County, single family, and this is condos and townhouses in both counties. And with that, I'll pause to see if there's any questions before I go on to what I believe is going to be the monthly data. This is a brand new graph. It should be before I get into the monthly data. And what I did, and it's a little overkill and I'm trying to decide what really works. The red line in the middle is probably the line that's most interesting. What I did is I looked at the sale price to list price ratio for every week starting in January of 1999 going to present day. And I looked at the least overbidding of 5%. So I did every 5%. I did 5%, 10 percentile, 15, 20, 25, all the way up to 95 percentile. So this is the highest overbidding. This is the lowest. The red is the median overbidding. And what's interesting, what really jumped out, this is not how I was expecting to present the data, but you never know when you start playing around with it. Look at these last couple years through here. These were our strong years, and these tend to be my base years. It is 19, which is up here. This is 17. So this would be 16. This would be 15, and then even 14 and 13. So we had several good years. These are fairly well behaved looking, but are fairly strong years. You go back here earlier in the years, and the middle of the market really wasn't overbidding that much. And so when you come over here, you're not as high up as these lines are. But in my opinion, anytime the market has a insult to it, like COVID, the buyers are more conservative in what they're willing to overbid. And I think we're still paying the price on that. But I think that's starting to break. And I think that's part of why that bulge is there. 15, 20, 25% of the buyers are starting to realize the market is strong and that we're far enough into COVID that they don't think anything's going to happen, and they're willing to get cut loose and start bidding aggressively to get the property. So anyway, each line isn't going to cross over each other, and you can just see the patterns. And the more the lines go up, you can sort of see the 100% right through here. The more you have above, the more hotter the marketplace was. And it's a colorful chart. And the hardest problem is to get something useful out of it. Yeah, it's useful. You can see the good years immediately, but there's just so much data, and not only in vertical and density, but also in years covered. Here is December data, since we're now reporting on monthly data. And there is a couple observations. Look how high the list price is. Almost $1.9 million is the median price on the marketplace. And if you jump down to what's selling, it's only 1.350. So how do you explain that huge discrepancy? The real expensive homes that were convenient for commute are not selling. The sellers that own them aren't willing to give up on the premium. The buyers aren't willing to pay the premium. So the homes are sitting on the marketplace. If they're sitting on the marketplace and they're high-end homes, that pulls up the median price. You can see inventory at 415. That's not the lowest we've been. We were only at 393 last year, but if you go back, you can see in 2019, we were at 600. In 17, which was the hot year, we were at 291. In 16, 483. So you can see we're in line. But if you go back to last decade, we're nowhere close. 1,500, almost 2,200, 1,600, 4,000, 4,000, 2,000, 1,600. Those were some high inventory. So when you look at 400, yeah, we don't have a lot of inventory. Moving on down the list into offers accepted. And also you can see the large square footage of homes here, 2,300. Isn't that much bigger. It's actually only about 75 square feet bigger than last year, and even, long-term history. So it's not the size of the home that's really staying on the market, but it's the cost of the home that's staying on the marketplace. Moving on to how long does it take to get offers? 24 and 9 days, average of 24, median 9. Compare that to what's on the market. What's sitting on the market on average has been on the market 81 days. That's almost 4 times as long. The median is 51 days for what's on the market versus 9. That's what, 6 times? Yeah, basically 6 times. What is that telling me? It's telling me that there's a segment of the marketplace that comes on the marketplace and sells immediately. Half the homes are selling in 9 days or less. And then there's part of the marketplace that just stays on the market forever because half the homes that are on the marketplace have been on the market for 51 days. If you've been on the marketplace 2-3 times the median, you're not going to sell until the market catches up to you or until you improve the property or do a price adjustment. I mean, it's crystal clear, and that's why the discrepancy between those two numbers. They're different data sets, and it basically says if you don't sell in 9 or 18 days, you're not going to sell. Moving down to the purple line is days of unsold inventory, 20 and a half days. That's pretty darn fast. That means we would sell out everything on the marketplace essentially in 3 weeks. I already hit on the median list price of what sold is $13.50. Sales per day is 20.2. And I also want to point that out. Look in recent history. I mean, we have to come all the way back here to 2012 to have a higher number of days of sales of inventory. And at that point, we had 1,500 homes. So you had 3 times as many homes to get as many sales. So, that's part of the aggressiveness that's out there. Moving down to closings, and you have to go to closing to get the sale price to list price ratio. This is somewhat interesting. We're only getting 103.8%, or maybe that's 103.6% of the asking price. So we're getting 3.6% more. If you go back and look at it, here in 2017, which was our phenomenal year, sellers were getting 9.5% more than their asking price. But if you ignore that 1 point, you keep coming back here, and there isn't a single month that comes close. So that gives you an idea of how strong we are. And I think this number here is artificially low because of the recent insult to the marketplace. And then if you look at the frequency of overbidding at 66.2%, again, except for 2017, which was a phenomenal year, there isn't a year that comes close to this. So single family homes in Santa Clara County are just absolutely on fire. Median price, 875,000, up from 800 last year. That's a 10% appreciation on the lower end of the marketplace. The middle part of the marketplace, the median that most people track, went from 1,250 to 1,380, which is exactly 1.3. So it's 10% of the new, which I guess it turns out to be about 11% of the old price. So about 11% appreciation on the lower end, and that's what you base it on. So on the 10 percentile, you had a little less than 10%. Maybe it's 9.5%. In the middle of the market, you had about 11% appreciation. And the high end of the marketplace, you went from 2,650 to 2,950. So you had 300,000 appreciation, which again is a little bit more than 10%. Now we're looking at the days of unsold inventory. That's the blue line. And again, as the blue line goes down, the market's heating up. So you can see it's still heating up. And this data is for December, which goes all the way through January the 4th at 11:59 p.m. The gold line is the average days on the market, and the future line is the median days on the market. So you can see the median days on the market is pretty low. You can see average days is pretty low, and you can see DUI is pretty low. Again, I put more weight and credibility into the DUI because it reacts more rapidly, and the listing agent can't really control DUI like they can control the days on marketplace. Here's the overbidding. This is the magnitude of overbidding up here, and you can see that we're below 105%, and I just read the number, and I think it was 103.6. So, sellers are getting more than they're asking on average. Anything between the horizontal blue line here and the horizontal red line is, I consider, a balanced marketplace. Since we're above the red line, we're into what I consider to be a red hot seller's marketplace. Then you come down here to the future line. This is the frequency of overbidding, and we're somewhere around 66%, I think is the number, 66.2 if I'm remembering right, which is almost, it is 2/3 of the sellers are getting more than their asking price. Yes, there's been higher periods of time here in 2017, which again was a phenomenal year, even some of these other peaks. But to be having the peak in December is what's unusual. Each one of these lines is basically December. So you're at a valley, you're at a valley, you're at a valley, you're at a valley, you're at an increasing valley here. So here we're increasing so rapidly that we went back over. But if this is the valley, that really suggests that next year we're going to go up like this. And I do believe that is what will happen, and time will tell. Now we're looking at, and this is sort of a repeat slide since I did not change the early ones over to January, but this is single family homes in Santa Clara County. You can see that this year is the second best year we've had, and this is comparing December to December. And this is December 1st for 35 days, which is through 11/59 on January the 4th, because there's 31 days in December. Now what I'm trying to do here is a 12-month average. Basically, you look at things and the median sale price right here, you can see it dipped down a little bit in 2019, and then it's been climbing back up. You can look at the inventory, which I think is the blue line. You can see inventory has been going back down. You can see that basically we were coming along here at about 1,000 listings on the market when you did a moving 12-month average. Then we dipped down in 2017 and 18, which corresponds to when the market was absolutely on fire. Then we sort of had a rebellion from the buyers, and we got into surplus inventory here in 2019, and we've been going back downhill ever since. And now we're sort of in a deficit, which is why the market's going crazy. Here is pricing. This is on semi-log paper, which may not be familiar to a lot of people, but it's nice because the slope of the line tells you the rate of appreciation. Here's the more traditional way of looking at it on analog paper. So most people follow just the median price. So now we got the extra data point on here. And so now it's a little bit more below. And the median price is what most people follow. I go ahead and follow the 10 percentile and the 90 percentile, because now what you know is 80% of the homes are between these two numbers. And this is sort of where the bulk of the market is right here. So it gives you a lot more information than just the median by itself. This is looking at the 10 percentile price to the median and the 90 percentile to the median at the top. And what that does is it allows you to see when the market's doing price compression and when it's doing price expansion. So as the lines were coming together here, sort of in the first 1/3 of the graph, you were having compression. And then we got into this period of time with the recession, and you had expansion, and we're having mild compression going on again. And that is it for the monthly data. And if I'll pause, see if I have any questions, and then I'll try to get back into the weekly data in detail. So here we have our 11 metrics that we look at. We have 5 graphs in each one. We'll only look at 1 slide per metric. There are a couple that I look at too. This is days of unsold inventory. So we have 3 major components. The red line is Santa Clara County single family homes. The brown, gray, tan line is San Mateo County single family homes. And the gold line is Santa Clara County condo townhouses. Days of unsold inventory, the lower the number, the better. Look, all 3 of these have turned upwards. Single families are doing better than condos. Santa Clara County is doing better than San Mateo County. All are slowing down. I think that's just a fluctuation in the marketplace. Look at what happened over here on the left side coming out of last year. See how rapidly these were going up? So I expect these to go up until about the middle of January. Probably could pick it out on if I looked at the calendar. Well, actually, this is the 9th, so next week is the 16th. So we'll go through that way through the 16th, and probably starting around the 20th as people start reporting the sales of the week of the around the 20th, when they're reporting the sales that happened on the 16th, that's when I expect this DUI to change directions again. Frequency of overbidding, you can see it's going down for condos and townhouses. It's going down in San Mateo County, and it's still pretty flat for single family homes in Santa Clara County. So it's the extra land, the extra privacy, and further away from commute markets that's really catching people's attention now. This is the magnitude of overbidding. You can see San Mateo County has dropped down. We were following on top of each other for single family, and then it dropped down starting here about the middle of November, where Santa Clara continues to hold steady, and the condos broke away much sooner, almost immediately after the pandemic was announced. Because remember, this is delayed by 5 weeks. So even though the pandemic started here, you can see that it wasn't reflecting till about here in the closings. This is during the period of time that we couldn't show any properties. Then all the markets started to improve. Condos quickly plateaued. The single families continued to go up until the middle of November, where Santa Clara County went flat and San Mateo County actually reverted a little bit. Here's days on the marketplace, sort of meaningless, sort of in the middle third, middle left here. That's because the MLS froze their data point. The days on market, they weren't counting. But look at the condos going up here. That's pretty significant climb. It's starting to reach a new equilibrium. But basically, the typical condos on the market now for 23 days. Now, you go anywhere else in the country and they'll say, what are you complaining about 23 days on the marketplace? Compare that to single family homes in Santa Clara County at 9. San Mateo County single family is at 16. So it's almost 50% longer from San Mateo County, and it's triple what it is for Santa Clara County. So it's all perspective. Here's the current available inventory. You can see the dip down. You can see it's already turned around and started going back up since we're past the end of the year holidays. This is the number of offers accepted. It's going to continue to go down probably. I'm not sure it's going to turn around this week. It may be one more week until it turns around. I almost would have to bet one more week. Here's the number of closed transactions. It lags behind, so there isn't anything noteworthy. Offers are noteworthy because that's what's happening in the marketplace. Closings is what happened 5-6 weeks ago. Here's the median sell price in the different micro market areas. And when I look at this graph, my initial reaction is it's flat, but I just went over the price increases, and we all know they were hovering around 10%. And when you actually go from here back to from the right hand side back to the beginning left hand side, you can see you've gone up probably about 10%, and you can see each of the micro market areas has gone up. You can see there's some fluctuations here in the different areas that are not all in sync with each other, and some of it's statistical fluctuation. That's why it's interesting to look at the data in this kind of detail. Here's the median price for the different benchmarks. So you can see in Santa Clara County, we went from 800,000, probably, well, we talked about it, 800,000 to I think 880,000. You can see San Mateo County went up. San Mateo County actually sort of peaked and crest here. And I don't know if that was, I would suspect that was just a statistical fluctuation. And that tends to happen a little bit when you're talking about a smaller sample size. San Mateo County has fewer transactions in San Mateo than Santa Clara County. Here's the median sold price, which is what most people track for all the different areas. Here it is for the 3 benchmarks. Again, there's really nothing that noteworthy, fairly flat. It's up about 10% over the year. Here's the 90 percentile, the same sort of thing, fairly flat, but clearly, in Santa Clara County, you're at $3 million and you started the year at 2.5 million. So you've appreciated almost 20%, but it depends on what number you take. If you take 2.6 here, or you take 2.4 here, there's quite a bit of difference. You actually got all the way up to 3 million way back here. That was sort of the bump that we saw in San Mateo County, but earlier. So that you got to be a little careful in drawing too much to it. Not a whole lot to be learned by this slide. Duration of close of escrows. Basically, everything's at 30 days. Don't try to close them too much earlier than that. Otherwise, you'll be going crazy. Here is days of unsold inventory. And I focus on that, and I focus on overbidding because I think those are key indicators. The days of unsold inventory is valuable because it tells us, what's happening right now in the marketplace today. Overbidding doesn't tell us what's happening until 5 weeks down the road after the escrow closes, but it gives you a sense of the pressure the buyers are feeling. What I'm going to do here is I'm going to try to step through and let you see how the area has changed over time. This is going back 5 Saturdays, basically 29 days. To December the 12th. And then we're going to step forward week by week. And the first one is going to jump, but after that, it's going to be pretty stable. So there's the jump. And now concentrate just on the color changes. So the goal of this slide is to let you see how the market does actually change over time, and it sort of ebbs and flows going through there. It's just sort of it's sort of like putting together a movie.
Richard, why there's a jump at the first slide?
Because I was doing these different ways as I was learning what worked and what didn't work.
Okay, but the rest of change is pretty clear.
Correct, because this is where I was using the standardized method. Any other questions? Because that's my end of my slides right there.